Hi, welcome to today's session. Today we're going to talk about liabilities. Let's get into it. What is a liability? A liability, as we went over, is something that you owe to somebody else. It's an obligation that you need to pay some money at a later date, right? It's due to a past transaction or event, and it creates a present obligation, the debt, and you have to fulfill that in the future. You have to pay some money. So you purchase some supplies. For instance, you purchase some supplies today, and your vendor sends you an invoice, and that invoice has a 30-day payment term. You need to pay that invoice in 30 days. So that is a liability that you have to record in your book. Okay. Now, how do you classify liabilities? Well, we have two different categories for liabilities: current liabilities and long term liabilities. Current liabilities, these are the liabilities, the obligations that you have to fulfill within 1 year or the company's operating cycle, if longer. And long term liabilities, these are liabilities that you have to fulfill within uh, a period that is longer than a year. So if you owe some money and you have a period more than 12 months to pay for it, it is a long-term liability. So on your balance sheet, you have two sections. One section lists your current liabilities and the other section lists your long-term liabilities. Known liabilities. What are known liabilities? These are the liabilities that you know for sure that you have in your books you're going to have to deal with. Okay? Accounts payable. This is, for instance, the supplies that you purchased. Your vendor sent you an invoice, now you have an accounts payable. Sales tax. When you make a sale, you collect sales tax on that sale. That is a liability because you're going to have to file your sales tax return and pay the government the portion of the sales tax that you collected. On earned revenue, this is when you collect somebody's funds and you to perform some kind of work or provide some kind of service. Until you perform that service, until you deliver the goods, this is unearned revenue to you because you have not fulfilled the obligation yet. Notes payable, this is a more formal types of accounts payable, usually longer for a longer period, like for instance a mortgage, a car note. Those would be considered notes payable. Payroll obligation, we talked about payroll earlier. Well, payroll is definitely a short-term liability because companies most, not most, but some of them run payroll every 2 weeks. That's the most common uh, period you would see bi-weekly payroll, but some companies run them twice a month or even every week. But payroll is classified as a short-term liability. Multi-period known liabilities, these are liabilities that you carry in your books from 1 month, from one period to another. Okay, here's an example for unearned revenue. On June 30th, Selena Gomez uh, sells tickets, $900,000 in tickets for 3 concerts. So on June 30th, the entry that she would record is a debit to cash because she collected $900,000 in cash, and credit on earned revenue. Remember, on earned revenue is a liability account, so you would credit that amount, that account for $900,000. Let's just say on October 31st, Selena performs one concert. At that time, look at the entry. She debits unearned revenue for $300,000 because that's one concert, right? If you collected 900,000 for 3 concerts, it's just basically assuming 300,000 per concert. So the first concert she performed, she debit unearned revenue and credit ticket revenue. At this point, she basically moved $300,000 from unearned revenue to revenue. At that point, she has earned the $300,000. So you can see already the balance in her unearned revenue account is now $600,000. Okay. Payroll liabilities. What are payroll liabilities? Well, these are obligations that you get from salaries, wages, employee benefits, payroll taxes that are levied on the employer. So if you have employees that work for you, of course, when they come to work every day, you don't pay them every day, right? So you have liabilities. Payroll liabilities are constant liabilities that you have. They're not constant, but they're recurring liabilities because every time you have employees work, you incur a liability. And until you pay them, that's a liability. Most employers, most companies run payroll every 2 weeks. Some of them do weekly payroll. But until you run payroll and pay those employees, you incur some liabilities in your book. That's payroll liabilities for you. Okay. Payroll deduction. If we work anywhere and receive a paycheck, we are familiar with the difference between gross pay and net pay. What is causing the difference? Well, it's the taxes, right? These deductions, federal income tax, state and local income tax, FICA taxes, and some of them would also be impacted by voluntary deduction. So if you, for instance, donate to a charity organization, that would be a voluntary deduction. But the federal income taxes, the state taxes in the states where they have income taxes, and the Social Security and Medicare taxes, these are mandatory taxes imposed by the government. There is no, you cannot get away with these. They have to be taken, from your gross pay, and therefore that's why when you have a paycheck, for instance, you have a $4,000 gross pay, but you better believe your net pay will be somewhere around three, between three, depending on your situation. Your gross pay, your net pay could be 3,500, okay, 3,200, and depending on your tax situation. As you know, we went over that. When you file that W-4 form, it indicates the amount of taxes that will be taken from your paycheck. Also, it depends on your tax bracket. Okay, so that's the difference between gross pay and net pay. That is payroll deduction. Okay, let's take a look at a journal entry to record payroll. Let's just say your gross pay, okay, gross pay amount was $2,000, and all of the taxes you deducted from the gross pay would be, for instance, the FICA taxes. You deduct $124, Medicare taxes $29, federal income tax payable 213, medical insurance 85, union dues 25, and you have the net pay $1,524. These would be your entries. You would debit your salaries expense for $2,000, which is the gross amount, and then you would credit all of these deductions and also the salaries payable to to record the liability. That's when you record the payroll, and then the next entry is when you actually pay the issue the paycheck. Then you would debit your salaries payable and you would credit cash. That's your entry to record your payroll. Okay, let's take a look at this class exercise to help illustrate what we just went over about payroll. This employee is a salesperson. He earns $36 an hour and he works 40 hours a week and is paid um, time and a half for any hours worked over 40 hours. Okay, so he works 42 hours for the week, and let's see what is his gross pay. The first thing we need to do, look at these answer choices, right? 1,548, 1,005. So the first thing we need to do is to really calculate the earning for the week. So 40 hours, let's look at his rate at 40 hours. Let me just use this. 40 hours time 36, right? That would be 1,440 dollars. That is his regular pay. What about his overtime? He works 42 hours, so 2 hours would be overtime. 2 hours at $54. How do we get $54? 36 times one and a half, that gives you 54 dollars. So that gives you 108, $108. And when you add the regular pay and the overtime pay, you get $1,548. $8. That is answer A right here. 1,548. That's the answer. How about this one? Certificate that authorizes an employer to withhold federal income taxes from each employee is called what? Hopefully you guessed it. That's a W-4. That's the form you complete when you first start on a job or anytime during the year where you want to make any changes to your payroll deduction, payroll tax deduction, you complete this W-4 form. Okay? Let's take a look at the employer payroll tax. We talked about the taxes that the employee has to pay. What about the employer? Well, let it be known that the employer pays Social Security taxes as well. They pay an amount that is equal to the amount they withhold from the employee's paycheck. So if the employer withholds $3,000 a year from the employee's paycheck, they must also pay $3,000. So the FICA taxes, the employer pay the equal amount. Federal and state unemployment taxes, these only the employer pays these taxes. So the employee does not pay federal unemployment taxes. So remember what is the unemployment tax? That's when an employee becomes unemployed, they go and collect unemployment. That's what this insurance is for. When any claims are submitted, that's where the government, you know, uh, find the funds to basically pay employees who are unemployed. Okay. What about multi-period liability? Multi-period liability is a liability that covers more than one period. Remember the example of the unearned revenue on the ticket sales for the concerts? That was a multi-period liability because if you remember correctly, the sales were made in June, and the first concert was not performed until October. And you still had two more concerts to perform, and then the next one could probably be somewhere in December, and maybe the last one could extend into the next year. So when you have a liability that you carry in your book for more than one period, it is called multi-period liability. Another type of liability is the estimated liability. We talked about known liabilities. The known liabilities is a liability that you know. Not only you know that you have a liability, but you also know the amount, right? But some liabilities, although they are known, you just do not know the amount. You can reasonably estimate the amount. That would be an estimated liability. An example would be like warranty, right? When you sell a product and you offer some type of warranty to the buyers, you don't know what kind of claim you're going to have and how many claims you're going to have. You know there is a liability out there, but you just don't know what it is. And pension could also be a liability, but that is also estimated. Vacation, even. You know the amount of vacation, the number of vacation hours you offer to your employees, but you don't know how many they're going to take, if any, right? Some employees would carry over those vacation hours. Some of them would take, you just don't know how many exactly. So you can estimate these amounts, but you don't know exactly what these liability amounts are. Therefore, they're called estimated liabilities. All right. So the last type of liability we look at is the contingent liability. A contingent liability is dependent on something happening. So let's just take a lawsuit, a litigation as an example. Okay. If your company is facing a lawsuit and your lawyer tells you, well, there is a probability that you will be losing that lawsuit, and here is the estimated amount that you may have to pay. At this point, the liability is probable and it's also estimable. So you can estimate it. So you need to record that amount as a liability in your financial statement. If, for instance, they tell you, well, the lawsuit is probable, the lawsuit is being filed, But liability is probable, but you don't have an estimate. If you don't have an estimate, you need to disclose the fact into the notes to the financial statements. Again, if the lawsuit also is possible, but you still don't have an amount, then you need to disclose it to in the notes to the financial statements. If the lawsuit is only remote, meaning there is no merit, somebody is just threatening to sue you, they haven't even filed a lawsuit yet. You don't need to do anything, no disclosure, nothing at all. Well, I know this lesson took a little bit of time. That's because we had a lot of good stuff to go over. Hopefully, you will find it helpful. If you have any questions, as always, please reach out, send me a note, email, or text. I will see you in the next class. Bye.